Good morning. This is Tom Alexander. It is Saturday, March 18th. It is 11:47 a.m. Eastern Time in beautiful Charleston, South Carolina. This is the weekly video addendum to the written report that I send out every week. If you're not receiving that report and you would like to receive it, it's free. Go to tom@alexandertrading.com. Send me an email. It's tom@alexandertrading.com. Requested put on the list. I'll put you on the list. Okay, there's a lot to talk about, and we are in a really interesting time frame in the markets where everything is driven by exogenous events. Now, you have two basic schools of trading, investing/trading, a macro and a technical. I've always made the case that I am really a value trader. Value is determined by the market. But in our present environment, I don't care what methodology, trading methodology you subscribe to. We are in a period of extreme randomness where, regardless of what it is that you're using to analyze the markets, that analysis can be proven wrong by one utterance by, for instance, a Fed official. We have Jerome Powell and the Fed show that begins on Tuesday. There will be a policy rate announcement that is, it seems like I say this every month, may be the most important that we've had in years. And then the guidance following that in the press conference. The markets are going to be tethered to that. You will have the people that drive the market directionally, which is not you and me, by the way. It's the big money. They will be trying to position in front of that. Some of them will, some of them won't, but there's not going to be a substantial move in this market until the overwhelming majority of the institutional money decides this is a bearish event or a bullish event. So we are at an important junction in the markets. My advice to all of you is, if you are traders, unless you're just a passive investor, is to, whatever methodology, whatever commitment you have in your account, trade lightly and have low exposure going into this, because we're sort of in coin flip territory as to the next 10 or 15% move in the market. I can make a bearish case, I can make a bullish case. Now, it does look to me like we are vulnerable, at least, to a downside washout. That said, and I put this in the written report, if all the markets turn around from here and they close above Thursday's high. When I say markets, I'm talking about the four primary U.S. indices: the NDX, the SPX, the Russell, and the Dow, the Russell 2000 RUT. If all four of those close above last Thursday's high, then that's at least short-term bullish. Let's take a look at the charts. Okay, I'm going to come back to this screen. This is a look at the technical stuff that we highlight every week. Let's just start with the charts. And let's start with the monthly chart of the Dow. And the highlighted area you see here is a 4-month balance area in the Dow. We're breaking to the downside. There is nothing on the monthly chart. There is nothing below this month's lows until you get all the way down to 28,618. Let's see what percentage that is, just for fun. So that would be about a 10% decline from here. Now, I'm not suggesting we're on the verge of a 10% crash next week. I'm just showing you that from an auction market perspective, there's no market support. This is an entire elevator shaft that was created in the ramp up back in October into this high right here. And then we balance for 4 months. Now, let's go down in time frame. This is just for reference. This is just context. All right, let's take, since I started with the Dow, let's go ahead and do the daily of the Dow. So here's the daily of the Dow. And now we can go a little more granular to the daily chart, and we can see last week's lows are critical. Last week's highs are critical. This is balance on a smaller degree time frame. Below last week's lows, there is absolutely nothing from an auction market perspective until you get down to 30,537, 30,198. And that's this area right in here. This is some volume. These are some daily lows. So how far are we from there? Well, let's see. That would be about a 4.5% decline. That's certainly well within the reach of a washout next week. Now, if we get above last week's highs, as I said, it's likely, at least short term, very bullish. But now all four of the indices need to do that. Okay, let's take a look at the SPX. This is last week's high. And then you have this area in here, which includes the low from last week, as well as this volume from the end of the year, the beginning of the year, prior to the ramp up into the February top. You can see the SPX continues to flirt around this 200-day moving average. That is important because people watch it, and the institutions watch it, and the algos watch it. So this level is important. To the downside, if we were to trade just to last week's lows, we'd be looking at about a 2.77% decline. That's no big deal. All right. Now, if we get down in here, then the market will be on edge, because it's not like this area is any big secret. Okay, let's take a look at the Russell. Now, the Russell is sort of on the edge of the abyss. Below last week's lows, there is nothing of substance. There's nothing from an auction market perspective that is likely support from previous trade, all the way down to 1668, 1640, which happens to be last fall's lows. Now, again, if we get above last week's highs, close above last week's highs, then something might be developing to the upside. Okay, let's look at the NDX. The NDX is blithely trading higher in defiance of technical and macro information. Apparently, this is the new flight to safety. A lot of the FANG stocks are attracting money because they apparently have a lot of cash on their balance sheets. But again, I'm a auction market trader. I trade price-based information. And one thing I'll say about this is that you have the Russell on its lows looking like it's going to trade into the abyss, and you have the NASDAQ looking like we're going to make new all-time highs. Something has to give here. Now, I'll also point out, and I pointed this out in the report, from last week's lows to this week's print highs, we traded up almost 8.5%. Even in a bull trend, that's starting to get extended. Now we're coming into this Fed meeting on Wednesday. Is this market going to continue to trade higher in front of that? That's not a bet I would be willing to make. However, something obviously has to give, because there's such disparate activity now among and between the indices. Pick any two, and there's just weirdness all over the place. And that's been the case since the February high. Actually, it's been the case back since December, but even it's been exacerbated lately, and it's certainly been in effect since the February high. Okay, let's take a look at the technical situation. The technical situation is, I can give you an if-then scenario. If we're going to wash out to the downside, you're going to get this 10-day moving average of advancing issues. And this isn't causation, it's correlation. The green arrows are days in which we close negative 2,000 or worse breadth. And you can see you have clusters of these at important lows. Now you can have clusters of these before important lows too, as you can see. Now, and again, this cannot be row traded. It is information, it's context. But the context of this is at the moment, the 10-day moving average of advancing, let's just leave this here and let's put another marker in here just for reference. And you can see this is the most extreme we've been certainly since last fall. And then this was last summer. This was last January 2022. You can see all of these levels marked lows or were close to lows time-wise. Now we can go down, 4 or 5%, 6%, 10%, I don't know, by Thursday. And time-wise, this is telling you it's near a short-term low. Now let's go back further in time, and you can see how from this particular indicator, how extreme it is. And we're starting to push some of the extremes that we saw last in 2020. Now, I'll also point out, if you notice, we closed below it here, and then we went, let's see, right here, then we went about 25% lower before you got a sustained bounce. You had bounces along the way, and I have shown that before. Don't know what I did here. Let's undo that. Bear with me a second while I fix this. All right, I don't know. I'm not going to take your time to figure this out at the moment. I'll come back and fix it. But basically, what I've same information applies here. We are extreme or getting extreme in all measures in this work. Now let's take a look at VIX. VIX is elevated, but like other terms, elevated is a relative term. If we're going to wash out next week, you're going to see VIX 30 plus, just as we did back here in the late fall, as we did in the summer, here and here, and all of these marked bottoms, and that's typical. Now, again, a 30 VIX is pretty elevated. It's starting to push extreme. But just to show you, extreme is a relative term. There are times where VIX can get much more extreme. Here's 40, and of course this is back in 2020 when we got up into the 70s, even 80s. So you have to be careful when you are looking at this stuff and thinking something is, and I hate to use these terms because they just don't apply and they destroy traders, overbought or oversold. I prefer extreme. And there are, of course, varying degrees of extreme. So you don't trade extreme, you're just aware of the context. But if we are going to wash out next week, even if we just approach this area, I think we'll see VIX spike up to 30. Now, as I said, the prudent thing to do here is to trade lightly and is to prepare for opportunity where you have a more defined situation. So we're going to see a massive bungee jump next week, or we're probably going to see a continuation of the washout that appears to be in effect. You guys have a wonderful week. Oh, by the way, one last thing. If you found value in this, please subscribe to the channel. Please like it. Please leave comments. I'm happy to respond to all comments. If you have any questions, do that. That helps me grow the channel. Thank you so much. Have a great week.